A very good morning, friends. So I hope everybody is doing good. And as I always say, that I hope your cumulative revision is taking place. So we were talking in terms of financial instruments, and so far a journey has been on Ind AS 32, where the focus has been on the issuer perspective. So we've seen the classification of the instruments from the point of view of the issuer. Broadly, I would say in terms of four categories. How do you say it is a financial liability, or is it equity instrument, or is it a non-derivative compound financial instruments, or it is supposed to be a hybrid instrument? And if you ask me in terms of the accounting, I guess we've only focused on a CFI, or you can say in terms of hybrid instruments, but we're yet to discuss the accounting as far as a financial liability is concerned. Equity instruments, of course, also the accounting is not much of a focus, because when you raise money through non-puttable ordinary shares, I think I'll use that word now, that you just need to put the entry, bank gets a debit, equity share capital gets a credit, and if there is any premium, you give a credit to share premium, or what you call a security premium. Now my focus today is turning on to the holder's perspective. That means we now need a change of mind. From the issuer point of view, now the focus is on the holder's point of view, that is on the financial asset. But I think before we understand how does the holder account for in the books of accounts, I think I need to give you some grounding work. I need to give you, a discussion with reference to what I call the different measurement bases which are available, I would say in Ind AS, but I would say in particular in terms of financial instruments. So what I'm giving you is also a very generic kind of a discussion, but then my entire focus is with reference to how the financial assets will be measured. So I think first I'm going to do some grounding work, because what I am actually trying to work upon is, I'll just show you a very interesting chart which is given in the study material. Wow, I just love this chart, and I think it might look to you a bit scary looking at this early in the morning. There are a lot of permutations and combinations which are there in terms of this particular chart. Like for example, you've got debt investments, you've got derivative investments, you've got equity investments. And if I just look at the last line below, there is something called an amortized cost. There is a fair value through other comprehensive income with a reclassification. There is a fair value through a profit and loss, and there is a fair value through other comprehensive income which is no reclassification. So I guess if nothing more, we can definitely see four categories of measurement bases which are visible in this chart. You can see AC, OCI with a R, then it is PNL, and it is OCI with a NR. I may not make much sense at this particular stage when I say that it is AC, or it is OCI with R, or it is OCI with NR, or it is a PNL. So I think before we appreciate this chart and understand that which financial assets are going to be measured at which particular category, you need to first of all understand things in a much more detail. So what I'm going to do, this chart is what is my focus today. But I think in order to come back to this chart and understand the nitty-gritties of this chart, I need to first of all do a little different discussion. I need to basically discuss with you the types of measurement base. So let's forget about this chart for the time being. And let's focus on the discussion that I want to discuss the different kind of what I say measurement base. So as I said, as I'm discussing these measurement base, you can relate this to the entire Indian accounting standard. Many standards which you've already done, you would have seen a different kind of measurement base. And as I discuss, a lot of things will come your mind as well. Broadly, if somebody were to ask me that what are the different measurement bases available, In terms of Indian accounting standard, I would say basically two measurement base. One is, I would say, is called a cost model. And the other one is what I would say is a fair value model. So broadly speaking, I would say there are two kinds of model as far as a measurement base is concerned. One is called a cost model and the other one is called a fair value model. Now let's understand the basic sense of a cost and a fair value model. Standard setters, while making these standards, had something in mind. Now, let me tell you, I am looking at the measurement on the balance sheet date. I'm looking at the measurement on a balance sheet date. The standard setters had something very interesting in mind, and they decided that either the asset is measured at a cost, that means initially it is measured at a cost, and even subsequently it is taken at a cost. So I will not capture any changes which happen in a fair value of the asset. A cost model will not capture any fair value changes. Now, mind all the inputs what I'm saying. In fact, today, what I'm going to say, every word has got a very important significance. I don't want to scare you. I'm not scaring you at the moment, but I'm just saying that there is quite a lot of possibility that you might like to revisit and look at this class again just to brush up your concepts further. It's not that you're not going to understand things, but at the same time, you might like to revisit. And if you do that, I think it's perfectly okay. Because in any case, you'll get this class on the ICAI YouTube channel as well, where you can just revisit and just, try to sharpen your skills as well. But it's going to be very important exercise because what I'm going to give you today is going to create a lot of foundations in terms of accounting for financial instruments, because now we are effectively starting Ind AS 109. Let me tell you, my focus so far is been on Ind AS 32, and now my focus is turning to Ind AS 109. So coming back to the point. So as I said, that when a company is supposed to measure the assets at a cost model, it means that you are going to initially measure it at cost, and even on a subsequent basis, it will be taken at a cost model. So we are not going to capture any fair value changes which will take place for the asset. But on the other hand, the standard setters decided that let's capture the assets at a fair value. Now, when you consider a fair value, then this fair value is computed with reference to Ind AS 113. Ind AS 113 talks about how a fair value is measured. So I will not get into the nitty-gritties of what is a fair value. I guess you know what is a fair value. So in this particular case, what the company would be required to do, it needs to measure things at a fair value at each balance sheet date. Which means I am going to capture the changes in the fair value at each balance sheet date. So let's get this straight. In a cost model, no fair value changes captured. In a fair value model, the fair value changes are captured in every balance sheet date. But the question is, where is the fair value changes taken? So the fair value model also is got a total of two variations. When you look at the fair value model, it all depends upon where are you going to capture the fair value change. So either it is captured in the profit and loss section or it is captured in the other comprehensive income section. You already know that income statement is segregated in terms of two elements, or you can say two sections. One is the profit and loss and one is the other comprehensive income. So when you capture the fair value changes, it is called FVTOCI. That's called a fair value through other comprehensive income. If you look at the language sometimes used in the study material, it is FVOCI. The word T is not there, but doesn't make a difference. Because when I'm using the word fair value through other comprehensive income, so fair value changes are going to be captured in other comprehensive income. And the other variation is what is called FVTPL. That's called a fair value through a profit and loss. So the basic idea, what they decided was that either you capture the fair value changes in the P&L, then it is called FVTPL, or you capture the fair value changes in the OCI, then we call it as FVTOCI. Now, there is another thing which I'll just pen it down, but we'll see that inputs a little later. In terms of FPT-OCI, they decided another input as well, and they decided that it is going to be either a case of reclassification, or it is a case of no reclassification. So they decided that when you capture the fair value changes in the other comprehensive income, it has got another two variations as well. One is that it is called reclassification, and the other one is called no reclassification. So this is going to be represented by the letter R, and this is going to be represented by the letter NR, reclassification, or you can call it as a recycling, and NR, what you can call it as a no recycling. So you call it as a reclassification or recycling. For the time being, we don't have a problem. Or you say it's no reclassification, or it is a case of no recycling. Let's not get into what is this R and NR immediately at this stage. So what is coming to the back of the mind is that when you consider a fair value model, and I say the fair value changes are captured in the OCI, FVTOCI. The fair value changes are captured in the P&L, FVTPL. And FVTOCI has got two variations. One is R, reclassification adjustment, and one is NR, there is no reclassification adjustment. Now, the million-dollar question which is coming to the mind is, when does a company use an OCI? When does a company use an FVTPL? What was there at the back of the standard setter's mind? In which kind of permutations and combinations we will tell the company to use an FVTPL or OCI? Now, one way of looking at things is this: you just cram up the list. That I give you the various permutation combination. If this happens, then this particular measurement base is used. Or the other one is you develop things on the basis of logic. So what do you want, friends, from me? You want me to give you directly what is to be done, or you want logics? Logic means a pain. And of course, after the pain comes the gain. I always tell people that pain is followed by a gain, and a gain immediately is followed by a pain. There are two parts of the same cycle. Either get the pain first or get the gain later, or get the gain right now and get the pain later. What do you want? Okay, we want with logic, so that means I need to give you a little pain as well, but trust me, that's a one-time pain. But then you remember things for a lifetime. The validity, when you learn things with logic, is a much larger period of time. Okay, so we're going to give you logics as well, that in which cases are we going to consider FVTPL, OCI, R, and R. Before that, let's also give you another input as well. When you look at a cost model as well, I would say there are two variations of a cost model as well. One is called historical cost. One is called historical cost, that is HC, and the other one is called amortized cost. So these are two variations in terms of the cost model. One is called historical cost, that is HC, and the other is amortized cost, which is called AC. So I guess if you notice, we've got a total of 5 permutation combinations of measurement base. One is, I would say, historical cost, one is amortized cost, one is OCI with the R, one is OCI with the NR, and one is FVTPL. Now, I think let's do one thing. Let's eliminate one of the models at this stage. When you look at financial assets or when you look at financial liability, one thing is very clear. We do not use the concept of historical cost at all. The concept of historical cost is being, devoted mainly to non-financial assets. Like for example, when you consider a PPE, when you consider investment property, when you consider intangible assets, when you consider inventory, all these assets are taken at a cost model, which is a historical cost model. So if I narrow down in terms of the financial instruments, I would say in terms of financial instruments, I'm saying in terms of financial instruments, we are not going to use the historical cost. Either we're going to use amortized cost or OCI with a R or OCI with an NR, or we're going to use a fair value through P&L in terms of financial instrument standard. So far so good. So I guess I've given you the different kind of measurement base. Now I think we've understood slightly what is FPTPL, fair value changes in the P&L. FPDOCI, fair value changes in the other comprehensive income. R&R discussion, I did it extensively when we had the very first class on Ind AS 1 presentation of financial statements, which I am just going to quickly take a recap. I'll not take you all in a very great detail. You can please refer that video as well, where we discussed about the concept of R&R, but I'm just going to give you a very quick recap of the concept. But I think the million-dollar question is, what is this amortized cost approach? And I think I need to give you, first of all, the insights on AC. So let's do one thing. Let's first understand what is this amortized cost, why it has been introduced in terms of financial instruments, and let's also understand thereafter the concept of OCI R&R. Once we've understood this AC, OCI R&R concept, then I think I'll be able to come back to the chart which I showed you in the morning. Let's take it further. So I think let me start my journey with reference to the first measurement base, and I am looking at the concept of what is this amortized cost approach. So I want to understand what is this AC, or what is called the amortized cost approach. Now for this purpose, I am going to take you first of all to a very simple example. Let's go back to the school days. And then we will take a simple example to understand more nitty-gritties. So I'm going to first give you the inputs on what we learned in school, what we learned in colleges. So let's go back to the school days and let's try to connect what we were doing in school days in terms of accounting. And I remember asking a few questions in my school days as well, but I think it was too premature to put those kind of questions in the class. And therefore, I was always told to sit down in the class. But of course, now the time has come to get up and stand out. So let's, I think, take the journey forward. I'm going to give you two situations and let's get answers on the two situations from your side. So I'm just going to give you very simple, plain vanilla situations. Let's say this is a T-shaped profit and loss account of two different companies. I'll give you two transactions on the basis of which you can decide your inputs. Let's say, for example, a company, I'm looking at from the issuer point of view for the time being. I'm not looking at the holder's point of view. Let's focus on the issuer perspective. Let's say, for example, a company took a 10%, they raised a 10% debenture with a face value to the extent of 100, and it is going to charge the interest in the profit and loss account. Would you like to tell me what is the interest it will pay on this particular debenture? Very simple. A company issued a 10% debenture with a face value 100. So naturally the interest is paid on the face value. So they are going to take an interest of 10 rupees in the profit and loss account every year. Now let's imagine another company, instead of paying a 10% interest, what they do, they are raising an 8% debenture, which has also got a face value 100. Undoubtedly, if I ask you what is the interest they will record in the P&L, I would say they'll record 8 rupee, 8% on 100. Now, hear this very carefully. The first company, when they issued a debenture at a par value, they also promised that they will pay this, they will redeem it at a par value. The issue of this debenture is being at a par value, and the redemption of this debenture is also at a par value. Now, on the second hand, let's say this company issues a debentures at a par value, but when it comes to a redemption, they will redeem this debenture, let's say, at a premium of whatever amount. Let's forget about whatever amount. So watch this example very carefully. One company raises the funds at a 10% debenture at a par value, redemption at a par value. Another company goes in for an issue of 8% debenture at a par value, but redemption at a premium. Now let's look at the inner story and ask you something after that. In fact, the second company also approaches the holder and says that I want to raise money through debenture. The holder says, give me a 10% interest. The company says, I will not be able to give you a more than 8% interest. The holder will say, then I don't want to deal with you. If you can't pay me a 10% interest, there are many people who are willing to pay me a 10% interest. Why should I give you a loan at the rate of 8%? So the issuer tries to convince the holder. He says, sir, I understand that you will lose 2% every year. He says, I understand that you're going to lose 2% every year. Since you're going to lose the 2% every year, I will compensate you this money by giving you a premium on redemption. Mind the words. I put it again. The first company raised the money at a 10% rate of interest. The second company, if it wants to raise the money, would also need to pay a 10% interest. But he convinces the holder that, sir, I'm going to give you a lesser rate of interest today. The holder will say, why should I give you money? If you're going to give me 8% interest instead of 10%, why should I deal with you? So the issuer tries to convince him that, yes, you are losing 2% interest every year. Because as per the market terms, I need to pay you a 10% interest. So you're going to lose the 2% interest every year. So I will indirectly give you a compensation in the form of a premium on redemption. Now my question, friends, is very simple. That naturally the deal will get stuck up. The deal will definitely happen. Because if you're able to convince the holder that for the 2% interest lost every year, you will compensate him in the form of premium on redemption, he might agree. Because it's just a matter of timing factor. It's like, you give him a 10% interest and no premium, or you give him an 8% interest with a premium, which is the premium to compensate the loss of interest. The other person may agree to the deal if he is compensated well enough in terms of time value of money. I hope you've understood my transaction very well. Now, my question is, when you were in school, does the interest still get recorded at 8%? Even if you're paying a premium on redemption to compensate the 2% loss, do you still land up recording the interest of 8 rupee? What do you say? Yes or no? And that's perfectly said, yes. And that's what the catch these standard setters realized. Now hear me carefully if you've understood the entire story. In this particular case, if you notice, this company, I would say, is actually being a smart company. If you actually ask me, I think he's been a smart company. Think in terms of crores and crores of rupee. Now imagine if I am able to convince the holder that I'll pay you a lesser rate of interest to be compensated later as a part of the premium on redemption. Then in that particular case, I am able to reduce the interest burden on my P&L for years to come. Let's say this is a 10-year-old debenture. I have been able to reduce a huge amount of interest burden on the profit and loss for a couple of years. And that means that I will increase my profits as compared to the first company. So, which means that I'm indirectly acting as a smart man. At the first instance, by reducing the interest at 8%, I reduce the interest burden in my P&L and increase my profits. Imagine that fellow, the first company, who is actually a genuine person, Sharif Admi, is basically paying interest at 10%. And imagine this person is acting more smart in life. He is actually reducing the burden of interest by paying a premium on redemption. And isn't that premium on redemption indirectly a compensation of the low rate of interest? Yes. By paying a low rate of interest at 8%, you are basically paying premium. So what is that premium? The premium is nothing, but it is indirectly a part of your interest rate itself, a part of your effective interest rate itself. And I think I'd like to remind you also that when you study financial management as well, in terms of financial management, what do? In terms of FM, when you calculate the effective cost of a debt, that's what you call KD, you say it's not only the interest net of tax, but you also land up including the difference between the redemption value and the net proceeds over the life. So you say that it is not only the interest which is a part of the effective cost of debt, but it is also the difference between the redemption value and the net proceed. What is the difference between a redemption value and a net proceed? It is the premium on redemption of issue. It is the issue, the discount on the issue of debenture. So this difference is nothing, but it is a representative of the premium which is paid on redemption. It is representative of the discount which is received at the time of issue of this debt. So we say that as a part of the effective interest calculations, the interest is a part of your interest, your cost of debt, your premium on redemption, your issue, discount on issue, they're all part of the effective cost of debt. So naturally, financial management was very clear. And even today, when you calculate a cost of debt, you are very clear that the elements of a cost of debt is not just the interest. The cost of debt is the interest which you pay, and you can say the premium on redemption or the discount on issue. So there is a need to calculate the interest at effective rate. Why should I tell the company that you are going to charge an interest at a contracted rate in the books of accounts? Tell them that you can structure the deal the way you want. You can structure the deal the way you want. Hear me carefully. You can tell them that you can structure the deal the way you want, but I will not allow you that what you pay is charged to the P&L. Mind the words. So I will tell the company as a standard setter, I can't stop you from structuring the deal. If the other person is willing to take a lower interest rate and get compensated in the form of premium, that's up to him and you. But your basis of the deal cannot become the basis of accounting. Because if two people are entering into a deal and they structure the deal differently, I can't prescribe two different accountings. If the essence of the deal is same, then the accounting needs to be common. Please analyze the words carefully. Two different people enter into a same deal on a different terms. One pays a 10% interest with no premium, another person pays a 8% interest with a premium, but at the end of the day, the substance of the deal is same. The second person pays a low rate of interest because he compensates that lower interest at the time of redemption in the form of premium. Effectively, he might also be paying a 10% interest. So why should he be allowed to charge 8% what he pays? Let us tell him that you're going to charge interest in accordance with what is, the substance of the deal. I hope, friends, I've made sense. I'll prove this to you also with the help of an example, and I will also give you the essence of how do you calculate this effective interest rate in the deal as well. I hope, friends, you got the inputs clear. Did you get my input so far? That what am I up to? I want to look into the transaction. I can't stop people from structuring deals, but I will definitely prescribe a common way of accounting things in life. If the companies are entering into deals the way they want, I can't stop them, but I will definitely prescribe that every company is given a common accounting. If the substance of the deal is common, they should have a unified kind of accounting throughout. Because earlier what was happening, a company pays a lesser interest, charges a lesser interest. It pays a more interest, it pays a more interest. The premium on redemption was not incorporated as a part of the interest expenditure in the P&L, resulting in companies manipulating the deals to their advantage, manipulating deals to the accounting advantage. Right? Did I make sense so far? Did you get the essence? Then I think I'll take an example. If you got the basic thought process, the essence clear. Okay, that's wonderful indeed. Now let's do one thing. So this very drawback led to the concept of what we call amortized cost. Now what I'm going to do, I will give you a deal. And we are going to understand how do you calculate the effective interest rate in the deal. Indirectly, I'm explaining you the concept of what is an amortized cost, and it'll take me at least around 15 to 20 minutes before I am able to, give you the essence of the concept, because I'll do some reconciliations as well. But once I'm done with the example, I will consolidate the entire learnings and tell you what is the concept of amortized cost. Now, this example which I'm taking is not from the point of view of the issuer. The deal I'm giving you is from the point of view of the holder, because at the end of the day, I need to basically, I'm looking at accounting a financial asset. So I'm giving an example from the holder's perspective. So let's give you a simple example. So I'm going to give you an example from the point of view of the holder. This is from the point of view of a holder. So we'll analyze this deal very carefully, the nitty-gritties of this deal very carefully with you. Okay, so let's consider that on 1st of January X1. Let's consider the dates. On 1st January X1, let's say we made an investment. Let's say the holder made an investment on 1st January, and the investment which he made is, let's say, in a 5% bond. He invested in 5% bond, which is, let's say, to the extent of 1 lakh rupee. This is the face value. So this is supposed to be the face value of the bond in which he made an investment. Now, when this investment was made, this bond was issued. This bond was issued at a discount. So this bond was issued at a discount, which is to the extent of 5,000. So when this investor made an investment, he invested the money at 95,000, which is at a discount. And let's also consider that he also incurred an issue expense. He also incurred certain issue expense. Let's call it as a transaction cost, TC. So let's say he had to incur 2,000 rupees of a transaction cost, like for example, a brokerage in order to make this investment. So 2,000 is the TC. Now let's see what are the terms of redemption. Let's see what is the terms of redemption in this particular case. So in this particular case, as far as the redemption is concerned, let's consider the tenure is supposed to be a period of 3 years. And the redemption will be at a premium. He was told that I will be giving you this money at a premium. So redemption will be at a premium, which is a premium of, let's say, 5960. So at the end of 3 years, he will be getting the money back at a premium, which is 5960 in this case. Okay, so that is the deal which is there with me. I need to understand how would he do the accounting in the books of accounts. So we want to look at the accounting in the books of the investor. I want to first of all, look at the deal in a very careful manner. Let me just analyze the deal with you. So let me just, I think, quickly consolidate the facts and let's understand the deal in this particular case. The investor in this case made an investment at a discount. The issuer at time zero told him that the bonds of 1 lakh rupee are going to be given to you at 95,000. And immediately he also incurred an issue cost as well. That means he paid a brokerage of 2,000 at time zero. And at the end of third year, he is getting a premium over and above a face value of 1 lakh rupees. That is 5960 at the end of 3 years. Now, let me make a few inputs to you. Please watch me carefully. I am going to put in a total of 2 to 3 sentences. If this clicks, I think I am almost done with my job. My number one, my first input. When the issuer gives the holder a discount of 5,000, please mind the words carefully. When the issuer gives a discount to the holder of 5,000 rupees at time zero, can I say he did a favor at time zero? If he did a favor at time zero, do you think the interest which he will pay will be less compared to market terms or more compared to market terms? Analyze carefully. My question number one is that once the discount is given by the issuer, he did a favor at time zero. So when he did a favor at time zero, do you think he will pay you interest at market terms or lesser than market or more than market terms? What do you say? And that's rightly said, he will pay an interest which is supposed to be less as compared to market term. Now, if I'm not able to raise 1 lakh rupees from you, but I'm able to raise only 95,000, why would I pay more interest? I am able to arrange a lesser money and therefore I'll pay a lesser interest, which means one thing is very clear, that this 5% seems to be decreased. This 5% is seen to be decreased because of the discount. Effectively, if you ask me, the market rate must have been much more. When the deal happened between the two, the issuer said, I will give you a discount right now, which means what? He is willing to take 95,000, but he's willing to pay back the money at a par value. Let's forget about the premium for the time being. When a company issues a security at a discount, what are they indirectly telling the holder? They are indirectly telling the holder that I will take 95,000 from you, but boss, I'm going to pay you 1 lakh rupees back. So that 5,000 money which you're going to pay at the end of 3 years extra money, it is what? It is indirectly interest. So the issuer is indirectly saying that today I take less money and I'm going to pay you more money at a later date, which will indirectly mean that I will never pay interest at market terms. I would have definitely lowered down the interest because of the discount given at time zero. Let's make another statement as well. In this particular case, we can also see that there is going to be a premium which is payable at the redemption. Now, let me ask you, the issuer is telling the holder, I will take 95 and give you not 1 lakh, but even more than 1 lakh. So in this particular case, he is going to do a favor at the end of third year. If he's going to do a favor at the end of third year, does this mean, let me put this question again, is he paying you interest at market terms or will he again reduce the market rate of interest? Why would he be willing to give you a discount at time zero and pay you market rate? Why would he be willing to pay a premium and pay you an interest at a market term? So my question back again, in this particular case as well, can I say the rate of interest that is 5%, do you think it must have been decreased or do you think it must have been increased? The issuer would have suppressed the interest rates to be given. Is he going to pay you more than market or less than market because he's paying a premium at the end of 3 years? And that's right, he would have decreased the interest rate here as well. Which means as an investor, I am getting, mind the words carefully, a lower interest initially, but I'm getting a compensation of getting a discount at time zero. As an investor, I'm getting a low rate of interest, but I'm getting compensated by the form of premium on redemption. I remember in school asking, this question back in school as well, that if I am paying interest, why would I pay a premium on redemption? If I am paying an interest, why would I give a discount to the other party? The logic is fairly simple, that if I am going to give you a discount today, I will never pay you interest on market terms. If I'm going to pay you a premium on redemption, I'll never pay you interest on market terms. Because if I am paying interest at market terms, why would I give you a premium? If I am paying interest on market terms, why would I give you a discount? So the deal is getting structured in such a way that if the person pays interest on market terms, there will be no premium on redemption. There will be no discount on issue. So when the deal has got a discount on issue, when the deal has got a premium on redemption, kuch to gadbad hai there. Are you getting my point? So the point is that the presence of a discount on an issue, the presence of a premium on redemption undoubtedly indicates that kuch to gadbad hai there. Did you get my point? I hope I'm clear with my concepts out here. You should be very conceptually clear on the agenda. The presence of a discount and the presence of a premium is possible only when the issuer lands up paying interest below market terms. And another input, there is a transaction cost as well. Now, imagine as an investor, I need to make investment in your company and I need to incur a cost to make that investment. I'm pretty sure you'll understand that I want to get an income which is able to recover this money spent. If I'm going to incur a transaction cost as a issuer, I'll tell you, boss, in order to make investments in your company, I have incurred some money. Please compensate me for this. So which means I would tell him to pay me a little more interest. So can I say the interest should have been increased to compensate this cost which is incurred by the holder as well? Correct? So there are a total of 3 factors which will now go in terms of deciding what is the real effective earnings of this particular investor. So what the standard setters decided, now watch this carefully. What the standard setters decided, you cannot stop 2 people from making a deal. They are 2 mature people. They understand the dynamics of finance and you cannot stop them from entering into a deal. Let them enter into the deal the way they want. But I am going to find out the essence of the deal and see what we're going to do. So what the standard setters decided in this case, let us document the deal. They decided, let's us document the deal in terms of cash inflow and in terms of cash outflow. Let us see the deal from the investor's point of view and see and look at the documentation of the deal. What is the inflows and outflows timing factor? Let's look at from the investor's perception. If I look at from the investor's perception, let's see what is the deal in terms of inflow, in terms of outflow. So from the investor's point of view, there is a cash outflow and there is a cash inflow. Let us see the inflows and outflows of the deal from the timing point of view. Let's go back. So as a holder, what you did, you invested a total of 95,000 at the inception. But then you had to incur another 2,000 on transaction cost. So I would say at time zero, the cash outflow is 97,000. You invested 95,000 and also incurred a transaction cost of 2,000. So 97,000 is what you paid at time zero in order to enter the deal. And let's see what are the inflows over the next 3 years. If I look at the inflows over the next 3 years, I can say I'm going to get a 5% interest on the bond, which is on the face value, of course. So I will be getting a 5,000 coupon rate of interest for the next 3 years to come. And at the end of third year, I will also get the principal money back. The issuer will pay me 5960 premium, which I said. So there is a premium of 5960 on the deal. So he's going to pay me 105960. He's going to pay you a face value plus a premium, which is paid on the time of redemption. So what we have done, we have basically documented the entire deal in terms of inflows and outflows of cash. We told the two parties, issuer and holder, you're free to deal the way you want. If you are ready to structure the deal the way you want, so that's okay. So you can structure the deal, and let me document the deal in terms of inflow as well as in terms of outflow. Now what I will do as a standard setter, I'll say I've got outflows on one hand, I've got inflows on the other hand, and I want to see what is your effective earning. So in order to see the effective earning, I'll say let me find out a discounting rate. Let me find out a discounting rate at which the present value of this inflow equals the outflow. And I think you can guess. The rate at which the present value of inflow equals the outflow is called what? Is called what in financial management? Would you like to tell me? So when you're looking in terms of the rate at which the discounting rate at which the present value of inflow equals the outflow, that's rightly said, internal rate of return. So we can say in this particular case, the discount rate at which you can say the present value of inflow equals outflow is called internal rate of return in terms of finance. Here in terms of financial reporting, I am going to call this as effective interest rate. So this is what you call in terms of financial management as internal rate of return. And the same thing we're going to call this in financial reporting in terms of Ind AS is called an effective interest rate. So this came the concept of EIR. This new accounting is called amortized cost approach. In terms of financial instruments, when you attribute an effective interest rate in the deal, this is called amortized cost approach. So the standard setters understood something very important. Don't worry, I'll consolidate more inputs. There is something more which needs to be elaborated at this end. So I told the two parties you're free to structure the deal the way you want. But after you structure the deal the way you want, I am going to consider the entire deal and document the inflow outflow. And I'll see that what is the effective interest rate in the deal, and I find out that. So what I need to do now in this particular case, I need to basically calculate an internal rate of return. So let's do one thing. Let's calculate an internal rate of return of the deal with our financial management tools. Now, in this particular case, I'll use a hit and trial rate. In this particular case, 5% is the rate of interest. But I know definitely for sure that the effective rate in the deal is more than 5%. As I've already said, that the interest rate of 5 stands decreased because of discount. It stands decreased because of the premium. So we know that the effective rate is more than 5. So let's take a 10% as a rate. So let's do one thing. Let's calculate the NPV of the deal at the rate of 5% and at the rate of 10%. And let's then interpolate and calculate the EIR. Sir, will the EIR be given in the question? Or am I supposed to calculate a EIR? Well, generally, of course, I've seen that if you look at the questions which are there, the EIR is given in the question. But of course, in the practical world, the EIR will not be given. You will have to locate the EIR in the deal. So therefore, I am trying to give you a little more practical exposure that when you're going to consider a deal between the two parties, you'll have to sit down, structure the deal on the Excel sheet on this manner, and then try to locate the effective interest rate in the deal. Our friends, making sense on the practical aspects? So in this particular case now, let's organize the present value of cash inflow, and let's organize the present value of cash outflow, and let's get the NPV of the deal. So let's organize what are the inflows and outflow. The data is already there with me, so we'll just organize the input. So we can say the inflow is 5,000 for the next 3 years, and the inflow is 105,960 at the end of third year. So I need a discounting at 5%. So let's see what is the factor at the rate of 5%. Third year end is 0.864. And the cumulative for 3 years is 2.723. Please verify the present value factors as well. And at 10% also we can take the cumulative factor and the figure at the end of third year. So third year figure is going to be 0.751. And the cumulative for 3 years is 2.487. 2.487. And as far as the outflow is concerned, it is 95,000 in the deal. So let's calculate the NPV. I'm pretty confident we're going to get a positive NPV at 5%. And hopefully if you get a negative NPV at 10%, that will only prove my point that the IRR is between the two. So let's see what is the NPV. 105,960, 864, 91549. 91549. So I guess this is coming to 8164. If you could just verify the NPV to me. Just see if this is correct. 2.487. This is 12,435.
Negative 4989.
Okay, this is 4989. First one is correct, beta. Just see.
Yes, sir. First one is correct.
Okay, wonderful indeed. So this is 4989 negative, correct? Okay, so that I think definitely proves the fact that we have a IRR in between the two, because you've got a positive IRR at positive NPV at 5 and a negative NPV at 10%. We can interpolate and calculate the internal rate of return or the effective rate of return on the deal. So you know the financial management funda. So we're going to consider the internal rate of return is 5% plus. So we can take the NPV at 5%. The difference in the NPV at 5 and 10, 8164 plus 4989, that's 13,153. And the gap of the range is 5%. So let's see, 8164 into 5 by 13,153. This is coming to almost like 8.1%, I guess, effectively. So this is coming to 8.1% is the effective interest rate in the deal. I hope you got the process now, which means what I have done at this particular stage, I have tried to attribute that what is the effective interest income on an annualized basis for the investor. I put it again. By looking at the deal, that this is the timing factor of the inflows against an investment, we are able to zero down that on an analyzed basis, the effective interest income the investor is earning is at the rate of 8.1%. So approximately, I'll take it as 8% for convenience. For convenience, I am taking it approximately to be 8% in this case. The analysis is not yet over. I want to take you a little more further in this. And let me also remind you, this concept you've seen in terms of Index 23 as well. When you consider the concept of borrowing costs and you say that we need to consider the interest on the effective interest rate under Index 109, even Index 23 is drawing a reference to this particular concept. That don't consider the interest rate which is quoted in the deal. That's what we call a contracted rate, like 5% in this case. But you need to look at the essence of the rate which is hidden in the contract, and that is effectively 8%. Now let's do one more thing. Let's also now make a leisure account for a better understanding, and then I'll do some consolidation of my discussions as well. I know a little technical discussions early in the morning, but I think it's interesting indeed. Let us now see the books of the investor, and I am looking at the financial asset in the books of accounts. As an investor, he's going to call this as a financial asset. So let's have a look at the financial asset in the books of accounts of the investor. Can you tell me how much money did he invest at time zero? Look at the outflow and look at the inflow statements. You've already organized the outflows, inflow. So what is the outflow at time zero?
97,000.
That's correct. 97,000 is what he invested at time zero. So this comes out here. And now what we need to do is something interesting. I need to accrue the interest in the books of accounts, and the interest will be accrued not on the basis of what you receive, but on the basis of what you're effectively earning on the deal. We've already calculated the effective interest rate is 8% on the deal. So the interest will be accrued on this deal. That's called a finance income. And this will be accrued at the rate of 8% on this. Let's see, 8% interest. I guess 7760 is the interest which is accrued on the deal. Now let's go back on the end of the first year. See what is the inflow you are getting at the end of the first year. Can I say I'm getting a 5,000 as a coupon rate, which is 5,000 received out here. Now let me tell you one thing more at this stage. The interest income to be taken in the income statement is not 5,000. The interest income which you're going to consider in your income statement is 7760. So this is what is going to be credited to the profit and loss account. This 5,000 is not the interest income. Earlier, if you go back to the school days, you would have recorded an interest of 5,000 in the books of accounts. But 5,000 is not your interest income. This is just the pattern in which the money is coming. It is not representing the real essence of the income. Now let's see what is the balancing figure, that is balance CD. So 97,
99760.
99760 is a balance CD. This is what will appear in the balance sheet as well. The balance sheet will represent a figure which is the balance CD. You will not show the investment at a cost of 97,000 or at a cost of 95,000. Your balance sheet will appear at this figure. Had it been a historical cost approach, you would have continued to show the figure at 97. Had it been a historical cost approach, you would have taken an interest income of 5,000 in the P&L. But in this case, we need to accrue the income based on the effective earning. Let's continue this. This becomes the opening balance next year. Let's again calculate the finance income 8% on this.
7981.
That's right, 7981. Again, you receive 5,000 as the contracted rate. We get the balance CD again as a balancing figure.
102
1 lakh 2,000
1,02,000.
741.
741.
741 is the balancing figure, and we get this as a balance BD next year. Now, in this particular case, let's not calculate the finance income. I'll prefer to take it as a balancing figure, but let's see what we're going to get at the end of third year. Now, at the end of third year, you're going to get two things. You're going to get a 5,000 interest and the premium money as well. So the money which comes out here is going to be 5,000 coupon rate and 105960 including the premium. So you could take the finance income as a balancing figure.
8219, sir.
8219, that's right, is the balancing figure, which is the finance income. My inputs are not yet done. I think the real journey now begins when I need to expose you the calculations in terms of this. Now see another inputs before we consolidate the entire learning. Let's make a reconciliation statement. Let's understand the reconciliation statement as well. What have we effectively done in this particular case? Now, if you carefully look at the two inputs I want to reconcile, how much is the amount which you have taken to the P&L and what is the benefits obtained over a period of time? But before this, let me ask you a simple little question as well. Can I say the amount of income credited to P&L should match with the collections at the end of the day? Agreed? At the end of the day, you do whatever accounting, but the credits in the P&L over 3 years should match with the collections in the bank. Agreed? I guess you agree with the funda. At the end of the day, when you accrue an expense, it is ultimately paid. When you accrue an income, it is ultimately collected. The collections should match with the incomes. The payment should match with the expenses. You may record an X amount in the P&L every year and you will collect a Y amount, but the sum total of all the X and the sum total of Y should match. Correct? That's right. Now let's see what are you crediting in the P&L. In the first year, in the second year, and the third year, the finance income credited is 7760. Second year, it is 7981. And third year, it is 8219. Let's see what is the total credit in the income statement. Add up all these three figures.
23,960.
That's right. It is 23,960. This is the finance income in the profit and loss. Now let's see what is the benefits obtained in the deal. The benefit obtained at time 0 was a discount of 5,000, correct? Then there is an extra money spent at time 0, which is the transaction cost of 2,000, correct? So the moment I entered into the deal, he gave me a discount, but I had to incur 2,000 extra money to make the investments. Then you can say first year, second year, third year, I got a 5,000 coupon rate of interest at the end of each year. So that is another benefits obtained. And I also got a premium of 5960, which is received at the end of the third year. Let's see what is the sum total of all these benefits obtained. So we can say 3 plus another 15 plus 5960. Wow, this is 23,960. Is this by chance the same or got to be G2B?
Got to be.
Wonderful indeed. This is 100% got to be. I know your mind must be feeling quite heavy after hearing all these things for the last 1 hour. So it's time to do a little consolidation of what we have learned so far. I have basically given you what is the concept of AC, that is an amortized cost approach. Let me consolidate the learnings. But I hope, friends, you've been able to catch up with the concept, because as you said, you want logics. So I am giving you a deeper logic in terms of how the concept is working. Let's go back. I started my day today telling you something about a measurement base. We are working towards a larger picture. We're working towards the concept of Index 109, where the beautiful chart is to be discussed. See the kind of background, which we need to create in terms of understanding that larger picture. So we decided that when a company is going to measure its asset, typically financial assets from the point of view of financial instruments, you've got a measurement base which is called a cost model, which has got historical and amortized cost approach, and a fair value model, OCI and P&L, OCI with a reclassification or no reclassification. At the first instance, I immediately threw out the concept of historical cost. Index 109 nowhere in the standard uses the concept of historical cost. So wherever a cost model is being used, the variation of the cost model used is called amortized cost approach. So we wanted to first understand that what is amortized cost approach. So I told you a few things. When I use a cost model, we do not capture any changes in the fair value. But when I use a fair value model, I am capturing the fair value changes. If you capture the fair value changes in the P&L, it is called FVTPL. When you capture the fair value changes in the OCI, it is called FPTOCI. R and R we'll see later. So what I did, in order to illustrate the concept of amortized cost approach, I took a deal with you. And I said that let's look at the deal from the investor holder's point of view. You made an investment in a bond at a discount. You're going to get a premium on redemption, and you've incurred a transaction cost. Now, there's something very important which I'm going to conclude in the next 2 minutes. So in this particular deal, we saw that there is a discount on issue, there is a premium on redemption, and there is a TC. So we understood one thing very clear. A plain deal is one where somebody pays me a market rate. Will there be a discount at the deal? No. If somebody gives me a market rate, will he give me a premium on redemption? No. When somebody gives me a market rate, do you think there will be any TC incurred? No. So one thing is very clear. If as an issuer, I am going to pay you a market rate of interest, I will not be giving any discount on issue. I will not be giving a premium on redemption. I will not be asking you to incur any TC to invest in my company. So one thing, that if in a question you see a discount on issue, if in the question you see a premium on redemption, and if in the question you see a TC, ghanti baji. I would say the moment you look at a question and in the deal, you find any of these three things, very important. You find any of these three inputs, you need to know that I need a EIR. So moral of the story. Let's pen this down. So I am giving you a moral of the story. I'm putting it as a moral of the story only. So this has been the story going on for the last 1 hour plus. So what is the moral of the story at this particular stage? The moral of the story is, if there is number one, discount on issue. The moment you say there is a discount on issue. Number two, you see that there is a premium on redemption. Number three, if you say there is a transaction, I will, in the future tell you, ghanti baji. The moment I read that, I will tell you the bell rings. And when I say the bell rings in this particular case, it will give rise to effective interest rate. One thing is sure, your coupon rate, the contracted rate and effective rate will never be the same. So when you see in a particular question that there is no discount, there is no premium, there is no TC, you will immediately come to the input that the contracted rate itself is the effective rate. But when you see that the informations on these three, 1, 2, all three, whatever, is given in the question, the coupon rate, or what I say the contracted rate, is never going to be equal to the effective rate of interest. So what I did in this particular case, to prove my point, I said, let's document the deal in terms of inflow outflow. When I documented the deal in terms of inflow outflow, this is what the deal looks like. I said, okay, let me calculate the effective return. I said, let's calculate the internal rate of return of the deal. So in terms of the internal rate of the deal, I came to know that you are earning effectively 8%. So let me put it like this and vouch me. If the issuer had given no discount, there was no TC, and there was no premium on redemption, would he have given me an 8% coupon rate? Yes or no? Can I say if there was no TC, no discount, no premium, would the issuer would have given me an 11%? That's right, sorry, 8%. Now, since there is a discount, there is a premium, and there is a TC, we can say that he's giving you a 5% and that 3% compensation. The gap between that 5 and 8% is attributed to discount benefit, premium benefit, increments of TC. So we said that in this particular case, now we'll tell the investor, boss, you cannot record what you receive as an income. You cannot record 5,000 as an interest income. You will accrue the interest at the rate of effective rate 8% every year, and you may keep receiving an X amount. So I will tell you to record this income in the P&L and not what you receive. This is your personal dealing with the other party, where you structure the deal according to your whims and fancies. And I can't stop you. Mia Bibi Raji, to kya karega Kaji? So in this particular case, I can't stop you from structuring the deal in this way, but I will definitely tell you, let's look at the essence of the deal. And trust me, if you're looking at an issuer perspective, he will also be paying interest, let's say 5,000, but I will ask him to charge a different rate of interest. I think this discussion would have also thrown light on the way we accounted for a financial liability in a compound financial instruments. I told you that in the next class you'll get a little more logic in terms of why the financial liability is getting accounted in that manner. Because we want to see the essence of the deal and then account. Right, friends, I hope I am absolutely clear on the concept of amortized cost approach using the concept of EIR in this case. Pretty clear, friends, on this, I guess. Let's get your comfort zone scores on the understanding of the amortized cost approach on a scale of 10. What is your comfort zone on a scale of 10 on this entire understanding of EIR? Effective interest rate. I like it. 10 by 10. That's wonderful indeed. Okay. So that was great. Now let's come back on the inputs, and I want to now discuss a few more things as well. Now let's get a little flavor in terms of these fair value approaches as well. I need to give you a little understanding of the OCI. We are now taking a recap of the concept of OCI, which I did in the discussions in the very first class. So first class means the very first class when the course started off. So let me just add on some more inputs of discussions to you. So let's now come to the concept of a fair value model. I will not discuss R and NR at this stage, but I want to basically now, understand a little comparative position in terms of AC as well as a fair value model to get things clear. Let's do one thing. Let's consider this to be an income statement. And let's consider a period of 3 years in this case. Let's consider a period of 3 years in this particular case. So I'm looking at year 1, I'm looking at year 2, I'm looking at year 3. We can even see more years as well. So let's consider now a few things. I just want to take a little recap and give you some understanding on this. So let's consider that this is the profit and loss section. And let's consider this is the other comprehensive income section. And we're going to get a total comprehensive income as well. And then we'll see a few things later. Now, let me just remind you a couple of things. One thing which I said that when you consider FVTPL, in this case, the fair value changes are captured in P&L. The fair value changes are captured in the profit and loss section. And when you say FVTOCI, that is a fair value through other comprehensive income, the fair value changes in this particular case are captured in OCI. They are supposed to be captured in the other comprehensive income. So I want to now see the implication, because now my agenda is which approach supposed to be used in which case. What was the focus of the standard setters, that which approach is going to be applied in which particular case? That is the focus of attention. Now let's, I think, consider the inputs out here. When you consider the fair value through P&L, can I say I will record the fair value changes in this section? I will capture the fair value changes in the P&L section. And when you consider the fair value through OCI approach, you will capture the fair value changes in the other comprehensive income. This is the meaning of FVTPL and FVTOCI. Now let me remind you something. When you capture the fair value changes in the P&L, does it impact the profits of the company? Say yes or no. At the end of the day, remember, you add up all this, and this is called the total comprehensive income, sum total of the P&L and the OCI. And that's right. So which means when you capture the fair value changes in the P&L, does it impact the profits of the company? Yes, it does. Does it impact the EPS of the company? Yes, it does. But when you capture the fair value changes in the OCI, does it impact the profits of the company? Yes, it does. But does it impact the EPS of the company? No, it does not. When you put things in the P&L, the profits, EPS are affected. But when you put things in the OCI, the profits are affected, but the EPS is not affected. What enters in the other comprehensive income does not enter the EPS calculations of the company. Quickly, let me pen down a few things to conclude my inputs. So now it's the right time to ask you a few things, and then I'll give you a selection criteria in terms of things. So I'm working on the selection criteria. We are working on the selection criteria of the measurement base. Having understood the concept of AC as well as FPTPL and OCI, I now need to understand which measurement bases will be used in which cases. Then I will be able to take you to the larger picture. Now, few questions, get ready. I'm looking at AC. I'm looking at FPTOCI. I'm looking at FPTPL. So let me ask you a few questions, and on this basis, we'll decide the parameters, that which particular parameter needs to be applied. Number one, do you capture the fair value changes in AC? Yes or no? When it comes to the concept of amortized cost approach, do you capture the fair value changes? Is the fair value changes captured in terms of AC? No. And do you capture the fair value changes in OCI and P&L? Yes. Let's now consider that due to this fair value changes, Is there an impact on the profits of the company? In terms of AC, no. If the fair value changes are not captured, then it has got no impact on the profits either. When you take it in the OCI, is the profits of the company impacted? Yes. When you take it in the P&L, is the profits of the company impacted? Yes. Now let's see the other one. Due to the fair value changes, I want to look at the impact on the earning per share of the company. Well, if you have not captured the fair value changes, naturally, there is no impact on the earning per share as well. Now, quickly coming to the second point. If you capture the fair value changes in OCI, does it impact the EPS? Think carefully. If you
No.
capture the fair value changes in OCI, does it impact the EPS? No. And when you put it in the P&L, does it impact the EPS? That's yes. Now it's time, friends, for you to take a call. If you have understood the inputs at this stage, let me now give you a call. And if you're able to decide this, I think one battle is fought. Now, please vouch me very carefully. Look at from the point of view of the impact on the profits and look at from the point of view of the impact on the EPS. When do you think the company will say, wow, this is good for me? Look at the impact in terms of profits and EPS and think from the point of view of both increase and decrease in fair value. Remember that if the fair value goes up and you capture it in the P&L, the profit EPS goes up. But then there is another side that if you take the fair value change decrease in the P&L, the EPS and the profit goes down. So when a company is using an FPTPL, the gain or the loss impacts the profits and EPS. Is your profitability EPS become an ECG report in life? Say yes or no. When you are going to consider the changes in the fair value in the profit and loss section, which means a gain of fair value will increase the profits EPS, a decrease in the fair value will decrease the profits in EPS. The volatility in terms of the profits and EPS will become an ECG report. So the company is being constantly monitored with open eyes. Are you performing good? Are you performing bad? But when it comes to the amortized cost approach, I'm telling the company no need to capture the fair value change. So there is no impact of the fair value on the profits, on the EPS. The company's impact on profit on the things is smoothened. So what do you think the company will be happy? If the company is given an amortized cost approach, can I say I am insulated against any capturing of fair value change? Increase, decrease doesn't bother me. My profits EPS is protected. Am I making sense? That if you're looking in terms of amortized cost approach, I am insulated against the concept of, you can say, fair value changes. So I would say the standard setters decided something very interesting. They decided things from the point of view of a risk perspective. If you remember, even in terms of Index 32, my entire evaluation was based on risk. When the issuer takes a risk, FL, when the issuer takes no risk, equity, when the risk gets divided, CFI, remember? Similarly, from the holder's point of view, the standard setters decided that the risk will be deciding the kind of risk the company takes. Now you will say, how would you decide a risk, sir? Well, they've given some very interesting, you can say, test with the help of which a risk assessment is done. The standard setters had given certain kind of risk assessment techniques in Index 109, which will help me to make an assessment whether the company is taking no risk or the company is taking more risk. So once I apply those risk assessment tests and I reach a conclusion that the company is not taking a risk, I'll tell them you can use an amortized cost approach. Since you are dealing with public money and you are not taking any kind of risk, and this conclusion comes in after I've made an assessment of the risk assessment models. So once I make the assessment of the risk model and I reach a conclusion that the company is not taking a risk, I will give them an amortized cost approach. I'll tell them, boss, your company is not taking any kind of risk, so therefore I will protect you from fair value changes. Go and apply AC. Your profits, no impact. Your EPS, no impact, because you have taken no risk. If the company, on the other hand, takes a high level of risk, if the company, on the other hand, my risk assessment tests tell me that the company has taken a very high level of risk, I'll say, boss, I will
FVTPL.
convert your financial statements into ECG report. So when the fair value goes up, your profit EPS goes up. When the fair value goes down, the profit EPS goes down. I will give the company an FVTPL. I'll give the company an FVTPL. So how the risk is assessed is a different story. How we're going to assess a risk is a different story. But once I am able to decide on the basis of risk assessment, once I'm able to decide on the basis of a risk assessment that the level of risk is supposed to be, no risk, I'll give them AC. When I say the risk is high, I'll say I'll convert your financials into ECG report. The fair value changes moves up, profit EPS moves up. Fair value changes goes down, profit EPS goes down. Your fair value changes is the monitor in terms of your performance in the company. And when I see that it is not that high risk, it is not that high risk, the risk is not high, but it is somewhere in between. Would you like to suggest me a measurement base? No risk is one extreme, AC, no impact on profits and EPS. And when you take a risk, then we are saying you are going to go in this approach, profits, EPS affected. And would you like to see the middle approach? The profit affected, EPS is not affected. So when the company is going to go for a situation where the risk is not that high. So, but how are you going to evaluate all these things? Don't worry, we will come to those risk assessment techniques as well, where we will see that if the risk is not that high, then in that particular case, we'll use the concept of a fair value through other comprehensive income. So moral of the story, that the risk assessment will tell me whether the assets are to be measured at AC or FPTPL or FPTOCI, but R&R is still pending. I like to go back on the chart number 1 with which I started my journey, and let's come back on this area. We started our inputs on the concept of a measurement base, and now we have clearly decided a few things which I would like to equivocally say this. Vouch me, friends, on that. Can I say number 1? The concept of historical cost approach never applies in financial instrument. If you ask me, historical cost approach doesn't apply in Index 109. Out. Can I say AC approach is allowed when I reach a conclusion that the company has not taken a risk? Second, number 3, the third statement, if I see that the company is taking a huge level of risk, there is a high level of risk the company is taking, I will suggest them FPTPL. And if there is, you can say, not that high risk, it is not that high risk, it is somewhere between the two extreme scales, then I am using FPD OCI. But where do we use OCI-R and where do we use OCI-NR? That is still pending. I guess, friends, you remember the inputs in terms of R and R. If not, We can discuss that later. But do you remember the inputs of reclassification, no reclassification done in the very first sessions when we started off with financial reporting? Do you remember that? If not, that's okay. But I think we did the inputs. I gave you the concept of R and R at that particular stage. Yes, that's great indeed. Okay, so this is the model of the story where I have given you the inputs in terms of that which measurement bases are used. Now it's time to look at the chart with which we started a morning today. Oh. So all this background which I was creating so far is been on this particular chart. Sir, my mind is already taking a lot of circles at this stage. It's getting a bit heavy. Don't worry, I'll give you a break very soon. But at this moment, I need to first of all introduce you a bit inputs about this. Let's make your life simple now. When I was looking at the issuer perspective, I gave you a 3-step model. When I'm looking at a holder's perspective, I'll again give you a 3-step model. We will translate this entire inputs, that is this particular chart, in terms of a 3-step model. So I will explain the nitty-gritties to you, but we will convert all this in terms of a 3-step model. So when you're looking at an issuer perspective, that is Index 32, a 3-step model comes into the mind. When you're looking in terms of the holder's point of view, we are again looking at the concept of a 3-step model. Now, let me tell you, first of all, where are the risk assessment tests? Now, watch this carefully and let me give you some insights at this stage. You can see this particular box, it is called CCFC. I just want to enter some terms in your mind. It is called CCFC SPPI test. This is one of the risk assessment tests suggested in the standard. The standard tells me that you need to apply the concept of what is called contractual cash flow characteristic. So when I use the word contractual cash flow characteristic, SPPI, solely payment of principal and interest, this is a risk assessment test which will tell me whether the risk is there or not. This will tell me whether the risk is there or not. Then you can see a test which is called a business model test. And there is a test which is called held for trading. This is what we're going to call it as a BM test. And this is what we're going to call it as HFT test, held for trading test, or what we call a BM test. So when you're going to apply the concept of a business model test or held for trading test, it will tell you the intensity of the risk. So I will work upon the risk is there or not. CCFC SPPI test. When I say, okay, the risk is there, tell me, is it high or is it not that high? I will apply the BM and the HFT test. On the basis of this risk assessment test, we will reach a conclusion that do we apply AC when there is no risk, or do we apply FPTOCI, which is R and R, which we have to learn, or do we apply FPTPL? And can you see this is red in color? When you see the red in color, it's dangerous. And why is it dangerous? Because when you go to put the changes in the fair value in the profit and loss account, your EPS and profits will get affected. When the EPS and the profits will get affected, which means danger, red in color. So now what we need to do in this particular case, we need to understand what is this CCFC SPPI, what is this BM, what is this held for trading, what are these risk assessment techniques. But I think before that, we need to give you a break as well, because I am going to work upon the inputs of all these areas with a 3-step model. So we're going to do that, of course, in a fresh mind altogether. So I'm now going to give you a break, but trust me, friends, what you need to do today is, of course, revise this very well. Because what I'm going to teach you today is going to form a base in terms of understanding, applying things, practical illustration. Because we'll start doing practical illustrations on accounting for investments using AC, using OCI and PNL approaches. And we will also have some special issues coming in accounting of these financial assets and all. I'll give you a map of mind also, not today, but in the next class where we are moving towards. So I think let's first give you a break, relax your minds. I'll join you in around 10-12 minutes time and we'll start the journey back out here. Enjoy your break. Okay. And so I hope you had a relaxation of mind. I think now let's begin a journey in terms of the three-step model which I told you. So I've given you that once we are going to look at the holder's perception, this is the chart what we're looking at, and now I will convert this into a three-step model to get a little ease of understanding in terms of things. So before we discuss this particular chart, I think let me just make some grounding work. My focus is now on the financial assets. My focus is now completely on financial assets. Now, let me tell you one thing. As I look at the concept of financial assets, I would say when I'm looking at financial assets, the focus is initial recognition, or you can say initial measurement, and the subsequent measurement. The chart which I've shown you is applicable not at the time of initial measurement. Mind it clear. The financial assets will be initially always measured at a fair value. I did not say a transaction value. I did not say a cost. I said it will be taken at a fair value. So let's get one thing very clear. When you look at the measurement of financial assets, so we're looking at the measurement from two perceptions, initial as well as subsequent in nature. So when you're looking at the initial measurement of financial assets, it is at a fair value. You heard me correct. It is at a fair value. All financial assets are measured at a fair value. So, but you never gave us the concept of what is a financial asset. You've been always focusing in terms of financial liabilities with us. You never drew attention in terms of what a financial asset is. Okay, so let's do one thing. Let's make your life simple. When you look at a financial assets, we can say the definition of financial assets is a mirror image of financial liability. Means when you look at a financial liability, you say it's a contractual obligation. So in terms of financial asset, it is a contractual right. And when you look at the financial liability, you say it's an obligation where the mode of payment is supposed to be cash or the mode of payment is shares. So in terms of financial asset, the mode of receipt is supposed to be shares as well as in terms of cash. So I think let's spend a little minute in terms of understanding, more inputs about financial assets. Rather, I am going to take you to the inputs and let's have a look in terms of examples of financial asset. So I'll just take you to the study material as well. And I guess in the study material, let's have a look at what is stated in terms of the unit number 2. I'll just add the inputs of the unit number 2, which is there in the study material. Rather, I would say unit number 1. So let me just take you to a relevant example at this particular stage. We'll just look at a few examples of financial assets. But I think before we look at the examples, let's have a look at the definition as well. Let me just, I think, crop this a bit so that we can see the definition clear out here. This is in the unit number 1 of the study mat. And let's have a look at the financial assets as well. So we'll look at a few examples also in this particular case. So let's have a look out here. Now, when I look at the financial assets, the definition given in Index 32, it says financial asset is any asset that is cash. Cash is a medium of exchange. And if cash is a medium of exchange, cash is definitely a financial asset always. Now, whether you say cash or you say the cash at bank, in hand or bank, both are included. So this cash means you're looking at cash in hand and you're also looking at the cash at bank. Then there is another element which is not there in the definition of financial liability. It says equity instrument of another entity. Now, I have some, intentions of, touching upon this definition as well, because there are a few things which I want to put at the back of your mind at this stage as well. So therefore, I've just come back on the concept of financial asset. Though we never discussed financial asset in particular, our focus has always been FL, equity, CFI, etc. Now, when you say an equity instrument of another entity, we are making a reference to investment in equity shares of the company. Now, please hear me carefully because I'm about to tell you a slightly little technical thing at this stage. When a company makes an investment in equity shares, it could be investment in a related party or it could be an investment in an unrelated party. Now, when you say it's an investment in a related party, we're looking at investment in a subsidiary, we're looking at investment in an associate, we're looking at investment in a joint venture. Related party investments are not under the purview of this standard. Let's get it very clear. When you say investment in equity shares of a company, related party equity investments is not under the purview of the standard. It is supposed to be outside the scope of 109. So, sir, these investments are not going to be accounted under 109. They are not to be accounted at a fair value. Yes, you heard me correct. So when you look at the equity shares, I would say that we are looking at investments in terms of, I would say, related party, or I would say the investment is in an unrelated party. So when you say it is an investment in a related party, I've already said investment in a subsidiary, investment in an associate, investment in a joint venture. These are all related party investments. So in this particular case, when you say related party, Ind AS 109 is not applicable. Get this clear. They are scoped out of the purview of this particular standard. So Ind AS 109 does not apply to equity investments in related party. These investments will be accounted under Ind AS 27. And Ind AS 27 makes it clear that these investments are taken at cost. These investments are taken at cost. So that's all what I wanted to make the point at this stage. We'll do more discussions later on this part. But when it comes to unrelated party investments, definitely Ind AS 109 is going to apply in this particular case, and these investments are going to be captured at a fair value. So let me just add on the points what I gave you at this particular stage. So I can say in this particular case, we can just put this in this particular stage once again to you. When I look at financial assets, we are saying equity instruments, that is investment in equity shares, is under the purview of a financial asset. So if you say that I've got investment in equity shares of a company, I'll say, hold on. Are you talking about related party investments in subsidiary, associate, and JV? Then it is scoped out of the purview of 109. And Ind AS 27 is applicable, and these investments are taken at a cost model. So which cost model? Historical cost model, not AC. So this cost model is going to be a historical cost model. But when it comes to unrelated party investments, they're definitely within the purview of this particular standard. Okay, let's go further. Then we are given that there is a contractual right to receive cash, or it could be also receiving entities' own equity instruments. The rest of the input is 100% the same. Now, let me caution at this stage. I'll make some notes also. So broadly, I would say that when you look at a financial asset, focus 1, cash. Focus 2, investment in equity shares, unrelated party investments. And focus number 3, contractual right to receive cash or equity shares in another company. So which means if you are getting a contractual right to receive not cash, not equity shares, but goods and services, then it is not supposed to be a financial asset. For example, let's say, let's say my company gave an advance to a supplier. Now, when I give an advance to the supplier, it creates an asset in the books of accounts, advance. But as far as the advance is concerned, is it going to give you a contractual right? Yes. But are you going to get the contractual right to receive cash or equity shares? No. I'm going to get the contractual right to receive goods and services. When I'm going to get the contractual right to receive goods and services, then it is not a financial asset. So any advances which you might have given to the supplier, or any kind of prepaid expenses which you have incurred, like for example a prepaid insurance or any kind of prepaid expense for that matter, you get a contractual right, but not to receive goods, not to receive cash, but to receive goods and services. And if the mode of receipt is goods and services, or even if the mode of payment is goods and services, Ind AS 103, 109 and Ind AS 32 is not applicable. Don't worry, I'll pen this down. So let's, I think, put this across. So first, I think, let me make my point and then I'll add something further. So let me just put something on the financial assets for the time being. So before we start discussing the accounting of financial assets, let's get the concepts clear that when you're looking at a financial asset, my mind is working clear that financial asset is into three broad categories. I'm not giving you the three-step model in terms of financial asset. We're just keeping it simple that if you're looking at a financial asset, it should be number one, ask yourself cash. Number two, it is investment in equity shares. It is investment in equity shares of a company. But in this case, we want to draw the attention that are you looking at related party investments, which is supposed to be investment in a subsidiary or a joint venture or an associate company, or it is supposed to be an unrelated party investment, or it is supposed to be an unrelated party investment. If you say it is a related party investments, then it is not in the scope of, Ind AS 32 as well as 109. But if it is unrelated party, it is in the scope of Ind AS 32 as well as 109. That is certainly a financial assets in this particular case. And I think worth making a mention further at this particular stage, when you say it is a related party investments, we can say Ind AS 27 applies, Ind AS 27 applies, and these investments are measured. So these investments are measured at cost. So when I say that they are measured at cost, we can mention in the brackets it is historical cost in nature. So these investments are going to be measured at a cost model, which is historical cost. And I think last but not the least, we can also say that financial assets where you get a contractual right, to receive, you get a contractual right to receive either cash or you get a contractual right to receive equity shares of the company. So when you get a contractual right to receive cash or equity shares of another company, and I think let's also make a mention out here, if we will receive goods and services, so if you're going to receive goods and services, then it's not a financial asset. So if we will receive goods and services, it is not a financial asset. The examples in this case, as I said, advance to a supplier, so you will get goods and services in return of the payments you've made. So they will not be considered as financial assets. And let me also tell you, even if there is a contractual obligation to pay in terms of goods and service, then also it's not a financial liability. For example, I get advance from a customer, it's a liability to me. But that advance from the customer will be discharged by way of goods and services, then that is also not a financial liability. So if the mode of payment or the mode of receipt is goods and services, it's not an asset or liability, not a financial asset or liability for the purview of this standard. Right, friends, I hope I made my point clear. So before we start the journey on financial assets, I think let's take some more examples as well. Now, there are some examples which are given in the study material. Let's, I think, have a look at those examples as well. So I will just capture those examples quickly to get a more clear understanding on this area. So this is the examples which are given in unit number 1 with the logic as well, whether they will be considered as financial assets or not. Let's read. It says investments in bonds and debenture. Well, it doesn't say that there is investment in equity share. When I am looking at investment other than equity share, it's always a financial asset. If you're investing in bonds and debenture, you're definitely entering into an agreement. So there will be a contractual right to receive cash in the form of interest as well as the principal repayments as well. So certainly we are getting a contractual right to receive cash. It is a financial asset. Loans and receivable, the same logic would apply. The deposits given, the same logic will apply. The trades and other receivable, the same logic will apply. The cash and cash equivalents is already specifically covered in the definition section itself. The bank balance is also supposed to be a contractual right to receive. Well, if I say cash at bank, then it gets covered in point 5. When I say a bank balance, then I get covered that there is a contractual right to receive cash. Let's take more examples which are given in the study. So let's, I think, give you more examples which are covered out here. So we are given now more inputs out here. For example, I am given investments in equity shares. It is a financial asset, but as I've already said, it depends upon whether it is related or not related party. Undoubtedly, it is a financial asset. Let me tell you, if somebody says that investment in a related party, is it a financial asset? Yes, it is. But is it within the purview of India's financial instruments? No, it is not. So there are two different questions. If you ask me, investment in related party equity share is a financial asset, it is. But it is not in the scope of the financial instrument standard. That is another agenda. Then perpetual debt instruments, you've already seen that it is a financial asset because that also gives you a contractual right to receive cash till perpetuity. So it is a financial asset. If you have invested in perpetual debt instruments, you are getting the right to receive the interest for an indefinite period of time. Okay, now when you look at physical assets like inventories, property, plant, equipment, etc. Well, these are assets which will not give you right to receive, but these are assets which will give you opportunity to receive money. So when you look at property, plant, equipment, or even intangible assets, or even investment property, inventories, etc. So right now they are saying physical assets, which means tangible assets in nature. They've taken the intangibles below, like patent, trademarks. Even if you're looking at the right of use asset, which is supposed to be a leased asset in this case, none of them are under the purview of this standard. They're not financial assets because they are going to create an opportunity to receive money, not a contractual right to receive cash. So this is only going to give you, you can say, create a right to receive money. They all create a right to receive money. Similarly, when you look at the prepaid expense, I've already clearly said that you are going to get goods or services in return. So that is not a financial asset. Advance which is given for goods and services, here again you're going to get in return goods and services. So they are not financial assets in nature. So I think now we are pretty clear with the examples that what are financial assets. I would say cash, yes. Investment in equity shares, yes. But related party is not in the scope. Unrelated is. Investments of other kinds like bonds, debentures, perpetual debt instruments, yes. Physical asset, leased assets, or you can say intangible assets, a big no. Prepaid expenses, advance for goods and services, no, because you are getting a right to receive goods and services and not cash in this case. Right, friends, I hope I am clear now with the picture in terms of what are financial assets. Quite similar, a mirror image of financial liability, but I think we've taken good examples as well. Okay. So let me take this further. So I guess I am now going to come back on the agenda. Just give me a second. The pages are too much to load. Let me just delete a few pages as well. Just give me a second so that I can delete these extra pages as well. Otherwise, the file becomes too heavy to digest as well. Okay, I think that's fair enough. Okay, so let me just come back on the picture now. We were discussing the inputs in terms of the financial assets measurement. So let me just come back on the agenda. So let's come back on the chart. I'm looking at now the measurement of financial assets. All financial assets are initially measured at a fair value, but there are exceptions. There are exceptions. So let's give you the list of the exceptions as well, that which particular financial assets are not going to be measured at a fair value. And there are basically two exceptions which we need to know, in terms of the standard. Exception number one, trade receivable. When a company makes a credit sale to the customer, it creates a trade receivable, and a trade receivable is recorded at the value at which goods are sold. It's not at a fair value. So when you go to consider a trade receivable, it is not recorded at a fair value, but we can technically say it is recorded at what we call a transaction value. A transaction value basically means the value at which the goods are sold. So they are going to be recorded at a transaction value. Another example, an exception of a financial asset which is not taken at a fair value, is a loan recoverable on demand. For example, my company makes a loan to somebody and I can recover that loan anytime. I can ask the person to pay the money at any point of time. It's a loan recoverable on demand. So if there is a loan which is recoverable on demand, that is also not recorded at a fair value. So that is also recorded at a transaction value itself. So let's keep one thing very clear at the back of the mind. If you say financial assets are measured initially at what value? Fair value. Remember, it's not at a cost. Unlike a PPE, intangibles, etc., which are taken at a cost, this is not taken at a cost. It is taken at a fair value. This fair value is computed with reference to Ind AS 113. We'll not get into how the fair value is computed, but I can say one thing at this stage, which I said earlier as well. What is the fair value of a liability? The present value of all the future payments. So what is the fair value of the asset? The present value of all the future inflow. The financial asset gives you a contractual right to receive money. So what you can do, you can make a list of all the contractual inflows you're going to get, discount them to time value of money, and you get a fair value. This is also called a DCF technique, a discounted cash flow technique in terms of getting the asset value. So generally, if a fair value is missing in a question, what you can comfortably do when you want to record things at a fair value, take the present value of the future receipts. So whatever is the present value of the future cash inflow, that is going to be the fair value of the asset. Now let's come to the next agenda, and that is, how does measurement of financial assets takes place? The subsequent measurement of financial assets will depend upon the three-step model which I am going to give you based on the chart. The chart which I gave you is going to be applicable now, and I said I'm going to convert that chart into a three-step model. So this three-step model is the same chart which is given in the unit number 3 of the study material. Not unit 3, I'm afraid, unit 2. So it is given in the unit number 2 of the study material, where I'm going to convert the three-step model. So let's get the model of the story clear. When you look at a financial asset, now you're clear what is a financial asset. A cash is a financial asset. Investment in equity shares, related party is under the purview of the standard. Any other asset which gives you a right to receive cash or equity shares, but not goods and service. What is the value at which financial asset is measured initially at a fair value? Are there any exceptions? Yes. If there is a loan recoverable on demand, exception 1, there is a trade receivable, exception 2. What is the value at which the financial assets are measured subsequently? We are going to learn that in the three-step model. So I am covering the three-step model to give you insight how a subsequent accounting of a financial asset is done. Let's now begin the journey. Let's talk in terms of the three-step model with you. Now, please watch this carefully. We will do a little more extensive discussions, and don't worry, I will consolidate these things also slowly and steadily. In the next class, at the very beginning itself, I'll consolidate the entire inputs of what we're discussing today. There will be a need, but you need to make a very solid revision of what we are doing today. I'll give you, first of all, a thought process in terms of step 1, in terms of step 2, and in terms of step 3. Now, hear me carefully. I have a financial asset. Let's take investment as a base. Let's consider investment as a base. A company A Limited made an investment in company B Limited. Let's consider an example. A company A Limited made an investment in company B Limited. Am I supposed to call up the accountant of B? Please hear me carefully. Am I supposed to call up the accountant of B Limited and ask him, sir, in your balance sheet, are you reflecting this as equity or a financial liability or a compound financial instrument? Should the accountant of A Limited give a telephone call to the accountant of B, asking him that, do you show this instrument as a financial liability, as an equity instrument, or a compound financial instrument? Now you will tell me, sir, I think you got your mind too tired and you are speaking something Greek to me. You seem to be tired since morning, is it? Of course not. You must be thinking that this is some kind of a joke, that I am saying that A Limited is going to give a phone call to this accountant of B and ask him, sir, what is the instrument appearing in the balance sheet of your company? Is it equity? Is it liability? Or is it a compound financial instrument? Well, I can say the answer technically is a yes. Though I would not say that I'm going to literally do that. I'm not going to literally do that. I'm not going to make a phone call to the accountant of B Limited, but the standard requires you to do something very interesting at this stage. The standard requires you that as A Limited is concerned, you need to step into the shoes. You need to step into the shoes of B Limited. You need to step into the shoes of the issuer. Please hear this carefully, get this very straight. as a holder, you need to step into the shoes of the issuer and ask yourself a question. If he calls it as a financial liability, it is a debt investment for me. If he calls it as an equity instrument, it is an equity investment for me. If he calls it as a compound financial instruments, it is a debt investment to me. My classification, whether it is a debt investment or whether it is an equity investment, purely depends upon the nature of instrument in which you invested. So as a holder, the step number one is to step into the shoes of the issuer. So A Limited will step into the shoes of the issuer, look at that arrangement, look at the contract he's entered into with B. The agreement is common. So whatever contract A and B have entered, the same contract is entered between the two. So A Limited will start making a scrutiny of the agreement and evaluate from the issuer point of view. So he will see that, let me see from the issuer point of view, let me apply Index 32. That if I was an issuer of the instrument, then would I call it as a financial liability? If he says it is a financial liability, it becomes a debt investment. If he says it is an equity instrument, then it becomes an equity investment. If he says it is a compound financial instrument, it is supposed to be a debt investment. I hope you got the point clear, friends. So the step number one is, as a holder, step into the shoes of the issuer. His equity, my equity investments. His FL, my debt investments. His CFI is my debt investments. So let me just give you the plain vanilla in terms of step one. So the holder steps into the shoes. The holder steps into the shoes of the issuer. He steps into the shoes of the issuer and he starts evaluating that if I was an issuer, what do I call it as? I guess I want to take you back on the chart, friends, at this very stage itself, so you can correlate this very well. Let's have a look at this chart. Can you see at the beginning, this is debt investments. I'm leaving derivative investments and this is equity investments. You can clearly see the word is debt investments and it is called equity investment. So what is a debt investment? When you invest in the financial liability of another company, when you invest in the compound financial instruments of another company, when you invest in the equity instruments of another company, it becomes an equity investment. Let's forget about debt investments for the time being. Derivative we'll see later. But of course, let me tell you that when you are entering into a forward futures and options contract and you're getting a right to receive, then it creates a financial asset, because even derivative instruments could create the right to receive. So if you enter into a derivative contracts, forwards, futures, options, and swaps, which gives you a contractual right to receive, then it is called a derivative investment. So that is step number one. Now let's come back on the step number two also with you. Now what I'm going to do in terms of the step number two is, I will do a risk assessment. I will do a risk assessment in terms of step number two. And I've already given you the inputs. The name of the test which will give me a risk assessment is called CCFC, comprising SPPI test. So when you do the risk assessment, I will be conducting a test which is called CCFC, comprising SPPI test. Sir, is this a common test for a debt equity investments? Yes. So when you apply this particular test, that is CCFC comprising SPPI, it is a common test which is applicable whether you've got debt investments or whether you've got equity investments. And what kind of risk assessment am I going to do in step number two? The risk assessment is whether there is a risk or not. In step number two, the risk assessment is to see the risk is there or not. The risk is there or not. Is the risk there or is the risk not there? Then I go to the step number 3 and again do a risk assessment. Then I go to the step number 3 and I again do a risk assessment in this particular case. And when I do a risk assessment in this particular case, there are 2 different tests. One is called a business model test, and one is called HFT, held for trading. Different tests. Don't worry, I'll consolidate the picture as well. I know too much data to remember. So when you're looking at the step number 3, if it is a debt investment, it is a business model test. If it is an equity investment, it is held for trading test. So the test in step number 2 is common whether it is a debt equity investment, but the test in step number 3 is different. For a debt investment, it is a business model test. For an equity investment, it is held for trading test. And what are you going to do in terms of the step number 3? Here the risk assessment is to confirm. It is to confirm that there is no risk. You will conduct this test to confirm that there is no risk. And if there is a risk, you need to find out the intensity of the risk. Is it high or is it not very high? Sir, I will go mad. How will I remember so many things in life? आपको मुझ पर दया नहीं आती? नहीं आती. You know, it reminds me, on a very lighter side, the movie which was Munna Bhai MBBS, where this doctor enters the room and tells that I don't love my patients. He says, if I'm going to love my patients, how will I treat them well? How will I be able to operate them? I think it same goes for a teacher as well. If you ask me, do you love your students? I would say, no, I don't. Because if I am going to love you, how will I give you the pain to learn the gain? And you said in the morning, you promised me, so we're ready to take the pain. We want the logics in this case, so I am giving you the pain. Do you like it? Say yes. No worries. Let me, I think, consolidate the inputs once again before we go deep into the 3-step model. Let's get one thing very clear, that when you're looking at the subsequent measurement of financial assets, the subsequent measurement of financial asset requires an application of a 3-step model. So let's first get the flow of the 3-step model very clear. In the step number 1, as a holder, you need to step into the shoes of the issuer. So when you make an investment, for example, in another company, you need to step into the shoes of the issuer. Assume that if you were the issuer of the instrument, how would you classify it under Index 32? So the very first step is that you need to step into the shoes of the issuer and visualize that if you were the issuer of the instrument, what would you do? And let me tell you, of course, as an issuer, or when you step into the shoes of the issuer, you cannot reach different answer. Now, you don't have to think like this, that the issuer would have said a FL. So what happens if I classify that as an equity instrument? Not possible. The agreement which is entered between the two parties is a common agreement, common to both the parties. So how is it possible that if an issuer looks at that instrument and the holder, looks at the instrument from an issuer perspective, that he cannot reach a different conclusion? So you need to step into the shoes of the issuer and identify that if you were the issuer of the instrument, if it is FL, his FL, my debt investment. His equity is my equity investments. His CFI is supposed to be my debt investment. So his financial liability, his compound financial instruments, debt investments for me. His equity instruments is supposed to be equity investments for me. So you need to first of all decide, in short, the financial asset is a debt investment, a financial asset is equity investments. That's what you need to decide. Once you've decided that it is a debt equity investments, the step number 2 is a risk assessment. The step number 3 is also a risk assessment. Now, two things which you need to be very clear on. The step number 2 is a test to decide the presence or the absence of the risk. You just need to see risk is there or the risk is not there. So you just decide the risk is there or not. But in terms of step 3, you reconfirm the risk is not there, or if you say the risk is there, you now need to see the intensity. Is it high or is it not high? Because that will decide my measurement base. So in step number 2, you are deciding risk is there or not, risk hai ya nahi. And step number 3, you are saying confirm risk is not there, ya mujhe batao risk high hai ya the risk is low. So the step number 2 focus is the risk is there or not. The step number 3 focus is confirm there is no risk or tell me the risk is high or not. And for the purpose of risk assessment, you've got two different kind of test. In step number 2, whether it's a debt or equity investments, it's a common test which is called CCFC comprising SPPI test. Contractual cash flow characteristic comprising solely payment of principal and interest. And then when you come to the third step, there are two different kind of tests. For debt investments, it's a business model test. For equity investments, it is held for trading tests. So common tests for debt equity in step 2, different tests for debt equity in step 3. So you should be very clear what is the agenda of step 2. To see the risk is there or not. What is the agenda of step number 3? To confirm the risk is not there, or to see the intensity, the risk is high or not high. Remember the focus in step 2, it's a common test for debt equity, but in terms of step 3, it is a different test for debt equity. I hope my 3-step model chain of thought is clear. So your mind should be now very clear. Step 1, you need to step into the shoes of the issuer. Classify it's a debt equity investments to you. Step number 2, look at the risk assessment. Risk is there or not. Step 3, confirm it back again. The risk is not there, or if it is there, what is the intensity, high or low? Did you get my point, friends, clear? Am I absolutely clear in this particular agenda? Great. And your teaching style is very nice, sir. I like it. Thank you very much indeed. Thank you very much for the good inputs, good words from your side. Encourages me to do better. Okay, so now what I am going to do, I am now going to make a run through of this 3-step model. Ask me how many times? 4 times. I'm going to run the walkthrough. Equity instrument is equity investments. Run through 1. His FL, my debt investments, run through 2. His compound financial instruments is debt investments, run through 3. And then derivative instruments, which means I've got a 3-step model to be run 4 times with you and then consolidate the picture. His equity instruments, my equity investments, model 1. His FL, my debt investments, model 2. His CFI is my debt investments, model 3. Derivative investments, we need to see all these 4 permutations combination. I think let's start with the easy one today. Let's not complicate the process as of now. You know, I've been getting a message since morning on my laptop where I've opened some site. It says suspicious website blocked. My God, am I speaking so technical inputs that, even the websites are getting hacked with some kind of, malwares and all? Oh my God. That's interesting to watch. Okay, so let's put it like this. Okay, let's, I think, take this further. So I am going to make a run through in terms of the first inputs to you. Please watch this carefully. I'll first take the equity instruments as a base in order to run my step number 1, my step number 2, my step number 3, and then I'll decide the remarks. So let's create this as a chart number 1. So we're going to basically create 4 charts. The life becomes simple now. Index 32, 3-step model, 4 charts. Index 109, 3 charts, 4 charts, and 3-step model again. Easy to recall the entire inputs as well. A stage will come when we will consolidate these inputs as well. We are almost like 40% done. Today is the 4th class. We've got 6 more classes in financial instruments, lot more coming in. So let's consider the step number 1. Let's consider the step number 2. And let's consider the step number 3. And then we'll decide what should be the measurement base. So get ready, because now you've got all the backgrounds to decide. You are going to apply the logic. And in this particular case, after applying the logic, you are going to give me the insights on that. Let's begin the journey. I am looking at the step number 1. I step into the shoes of the issuer, and then I decide my category. So let me put that question to you. As an issuer, I applied Index 32 3-step model, and I reached a conclusion that it is equity instruments for the issuer. Can you tell me what is it for the holder? Categorize this. What is it for the holder's point of view? So what do I classify this as a holder's point of view? That's right. It becomes an equity investment. So I'm going to call this as an equity investment. So this is an equity investment. The step number 1 is done. Now let's have a look further. In this particular case. I am now going to conduct the step number 2, where I need to apply the CCFC comprising the SPPI test in this particular case. Now please hear this carefully. Let's say I am the holder and the person, the issuer, is standing there. Nobody is standing there, but I'm just trying to look out there that he is the issuer so that I can put some questions to the issuer. So he issued an equity instrument. I'm going to put a question to him. Do you have a contractual obligation to pay interest to me? He says no. I say, do you've got a contractual obligation to pay the principal to me? He says no. You're getting my point? I'm asking the issuer. I'm stepping to the shoes of the issuer and trying to put a question. Do you have a contractual obligation to pay the principal, or do you have got the contractual obligation to pay the interest? And he says no. That's why I call it as equity instrument, because I've got no contractual obligation to pay you the principal or to pay you the interest on that principal. If he has got no contractual obligation to pay, do I get a contractual right to receive? No. The absence of a contractual obligation on the issuer is indicative of an absence of a contractual right to receive as well. So in this particular case, when I say contractual cash flow characteristic comprising solely of payment and principal and interest on that, am I getting the contractual cash flow, CCF? Am I getting the contractual cash flow characteristic of getting solely payment of principal and the interest? Solely payment, SP, of principal, P, and interest. You need to ask yourself a question. Are you getting the contractual right to receive solely the payment of principal and the interest on the principal? So what would be the answer? Of course, a no. The issuer says it's an equity instrument indicates an absence of a contractual obligation to pay interest and principal both. So as a holder, there is an absence of a contractual right to receive the money. So I would say this test will undoubtedly fail. 100% the test is going to fail in this particular case. Now let me ask you something. From a risk perspective, if this test is failing, what does this mean? You've invested in an instrument which is risky or not risky? You tell me. What do you think in this particular case?
Risky.
Absolutely makes sense. The moment you say that this test is failing, it indicates that the risk is there. So that is my step 2, which is telling me that the risk is there or not. I hope you got the position very clear now. The step number 2 is a risk assessment test where the other party has got no obligations to pay. So as a holder, you've got no right to receive. So you have made investment in an area where you are getting no right to receive. It's a risky investment. Then I go to the step number 3 and I give you that for equity investments, you need to apply the HFT test. I think let me put the full form as well. This was contractual cash flow. This was contractual cash flow characteristics. Contractual cash flow characteristics. And this is comprising solely of payment, solely payment of, not of, solely payment of principal and interest. Solely payment of principal and interest. So you get the contractual cash flow, which is comprising solely the payment of principal as well as interest. And when you look at the HFT, we can also define the HFT. This is called held for trading. This is called held for trading. That is called HFT test. Now, let's, I think, go to the third step where we're looking at, a confirmation risk is there or not. Risk is there in step 2. So we're looking at now the intensity of the risk. Is the risk high or low? Let's put a question to you. So I made an investment in the equity shares of another company. And in this particular case, I said, are you going to give me interest? They said, no. Dividends, no. Principal, no. It's a risky investment. Now, on the top of it, I am asked, what is your intention with this investment? I said, I'm going to do intra trading with this investment. I'm going to do trading with this investment. If I'm going to do trading with this investment, what do you say? High risk or low risk?
High.
That's wonderful indeed. If you say that, yes, I am going to do trading. So in this particular case, if you say, yes, you are going to do trading, I would say it is a high risk. Now you can answer me, if it is a high risk, please suggest a measurement base. You know the permutation combinations. The risk is there and it is high risk in nature. Please suggest a measurement base. AC?
FTPL.
OCI? Wonderful indeed. FVTPL. It's a risky investments and therefore I'll tell them that you got to measure them at FVTPL. And there is another way of looking at this as well. In this particular case, the mere intention is to get a capital gain. So which means the changes in the fair value represents a capital gain or a capital loss. If the company is made this investment with the idea of getting a capital gain, let's capture the capital gains or capital loss. So your profit changes, your EPS also changes. Let the stakeholders know that you've invested money in equity instruments and this is the capital gains or losses which is happening on account of these investments. Let's say if the answer comes, say, no, it's not held for trading. Does this likely get less? If you make investments in equity shares with a little long-term perspective, can I say the risk slightly gets a little less as compared to trading? Correct? Can I definitely say in this case, the risk slightly gets a little reduced in this particular case? Correct? Yes. So I would say it's not that high. If it is not that high in nature, would you like to suggest a measurement base in this case?
PTOCI.
Wonderful indeed. So it's going to be called as FVTOCI. And let me also tell you at this stage, equity investments are always with a no recycling or no reclassification. And debt investments, if they fall into OCI, is always going to be a case of recycling, that is reclassification. And why did the standard setters decide that? That all we'll see later, not at this stage. But I just want to tell you that if it is equity investments, then those equity investments, if they're taken at FPD OCI, is always NR. Had it been a debt investments, it is always supposed to be R. So my chart number 1 is done. I've looked at the aspect of the equity instruments called as equity investments. The second step will fail for sure. And the third step is all intentions dependent. If the management tells me that it is supposed to be trading FPTPL, if they tell me that it is not for trading FPT OCI, but the standard setter said that if it is not held for trading, we'll give you a choice. The standard setter said that if it is not held for trading, we give you a choice. You can either go for FPT OCI or you can go for FPTPL. They said you still want to choose an FPTPL, you can. You want to choose an FPT OCI, you can. It's a pure choice. There are no ifs and buts. It's a complete choice altogether. But let me tell you, this choice is what we technically call is an irrevocable option. It's like the Salman Khan dialogue. एक बार जो कमिटमेंट कर दी उसके बाद तो मैं अपने आप की नहीं सुनता. So this is going to be an irrevocable option. In this case, you will have to select this option once for all and you cannot change. So this is going to be a selection which is an irrevocable. It's an irrevocable option. Once you exercise this particular option, you cannot take a U-turn. You need to consider the investments is going to be measured at FPTPL or OCI. I know it's getting a little technical indeed, but I want to say something more at this stage. Can I? Yes, sir. Please go ahead. Thank you. Somebody never said yes. Thank you. So I want to also give you a little more insights now on this particular aspect as well. Let me first consolidate these movements and then add something more to these points as well. So to be very clear with the chart number 1. Because the debt investment chart is not what I'm going to touch today, because that's a little more extensive chart. Derivatives are simple, so we're just going to give you an inputs on chart number 2 right away. Okay, so let's come back to the picture. You are stepping into the shoes of the issuer and you are saying, what is the investment you made? You invested in equity instruments of another company. Then it is equity investments for you. If you made equity investments, one thing is pretty sure that this is a definitely very risky investment. Because when you make investments in equity, you do not get entitled to any returns in the form of interest or dividends. You do not get entitled to any kind of principal assurance. So your contractual cash flows is not comprising of principal and interest. This test will fail. So then, sir, what is the point of conducting this test? Can I outrightly say the step 2 is fail even without this applying this test? You can. And then you go to the step number 3 to see that is this investment held for trading? If yes, very risky. FPTPL, take the changes in the fair value in the P&L. And if it is not held for trading, you get a choice which is an irrevocable option. Either you consider FPT OCI with a no recycling or FPTPL. And let me tell you one thing, a company has to be very conscious in terms of the selection. If you consider FPT OCI, the fair value changes will enter the OCI. The gain or loss on sale of the investment will also enter the OCI. You heard me correct. Don't worry, we'll document this later in the next session with you. But I want to make it clear, if you consider FPT OCI, The fair value changes which are unrealized in nature enters in the OCI. The profit or loss which is realized in nature also goes in OCI. By choosing this particular category of OCI, every movement is captured in OCI. You make a sale of the investment, you get a realized gain or loss OCI. There is a fair value change OCI. You heard me correct. Realized gain on sale, OCI. Realized loss on sale, OCI. Everything will enter the OCI. But if you choose an FPTPL, it's a complete contrasting treatment. The fair value changes in the P&L, the realized gain or losses also in the P&L. So when you choose an OCI for equity, everything OCI. When you take a FPTPL, everything in the P&L. So the company has got a free choice, but they need to be very conscious in terms of taking a call that they're going to take these investments at FPTPL or OCI. And from the examination point of view, let me tell you that FPTPL is the default choice from the exam point of view. From the exam point of view, this is like the default category which we're going to use. So moral of the story is very simple. If you see in a question, a company made equity investments, thank you, FPTPL. I don't need to look into this any other things in this case. Examination point of view, I'm saying. I will simply say that if you have made equity investments and if nothing is given to the contrary, it is by default FPTPL. Right, friends? I hope I have made myself clear. I just want to take you back on the chart as well. So let's have a look at this chart once again and let's see some inputs at this stage. I just want to show you the equity investments run through of what we have discussed so far. So let's have a look at this particular part. So let me just, I think, give you a little run through on this part. Only see what we look at this particular chart. So let me have a look out here in this particular case. This is equity investments. This is like step number 1. When I made investments in equity instruments, I call this as equity investments. This contractual cash flow comprising SPPI, that is like my step number 2, which you can see clearly is failing. I've given you the logics also now. Step number 1, equity investments. Step number 2, the risk assessment fails. And then you go for held for trading. This is like the step number 3. And in terms of the step number 3, if you say yes, it is held for trading, then you are under FPTPL. And if you say no, it is not held for trading, then it says FPTI option is selected. And as I said, it is supposed to be an irrevocable selection. So if you select it to be an other comprehensive income, and if you say yes, you select it, then it is OCI with a no reclassification. So this is NR. And if you say no, I don't want the selection, then it is FPTPL. I have covered 50% of the chart out here. So step number 1, it is equity investments. Step number 2, you fail the CCFC SPPI test for sure. Step number 3, held for trading. If yes, FPTPL. If no, you got a choice. You want to select the OCI, then it is OCI. And that's the reason we said, if you select OCI, and if you don't select OCI, then in that particular case, FPTPL is the default selection. So moral of the story, if a company makes an equity investments in unrelated party investments, I would say by default, it is FPTPL unless a company makes a choice of FPT OCI. So if there is, I would rather say related party at cost, unrelated party held for trading is FPTPL, unrelated party which is not for trading depends upon the choice of the company. Right, friends, I hope I am clear with the entire permutation combinations on this. So far, so good on this. So let me just map down the moral of the story out here. So before we close, let's put down the moral of the story in terms of equity investments. So we'll be working on the other three charts also in the next class with you, but we've made our point very clear. If you say equity investments, I will say moral of the story is something like this. If you say it is a related party investments, I will say you will take this at cost, historical cost. If you say it is unrelated party investments, I would say, okay, tell me first of all, in this particular case, is it a short-term investment? When you say held for trading, we're basically saying it is short-term in nature. And if it is held for trading short-term in nature, it is FVTPL. And if you say no, it is not held for trading, that means it is not short-term in nature. If it is not short-term in nature, then I would say it is by default FPTPL. It is by default FPTPL unless the company chooses an OCI. So we can say in this case it is by default unless we choose FVTOCI, that is NR. That is only if you select, otherwise by default it is supposed to be FVTPL. So cost model for related, and you can say fair value through P&L for unrelated party investments. This is the net concept, you can say. This is the moral of the story. All right, friends. So this takes care of my inputs in terms of the chart number 1, that is equity investments. I will make my discussions on debt investments, on derivative investments, and two types of debt investments, FL, CFI, and derivative investments, and then consolidate this input. And then I'll start doing practical illustrations with you on this area. So that seems to be quite good for the day. You must be feeling heavy, but if you remember, as I requested, and I would insist, today's class is something which you need to revise. If the need be, please watch this class again. It'll be there on the YouTube ICAI channel, and you can watch this again, maybe 1.5x, 2x, whatever you can bear me. But I think do make your revisions to get more strength on your concepts. Over to you, friends, for any questions on your side. So your teaching style always keeps our mind fresh and clear, all the topic with deep logic concepts. You make us smile during the lecture, which is very much energetic to us. Thank you, sir, to teach us. Thank you so much indeed. I think that's so beautiful words. I think, Ginny, I think that's so sweet of you, that I think encourages me a lot indeed. No questions left. That's wonderful indeed. So I think that I feel blessed, to be on this platform with such wonderful audience indeed. Really feel blessed for that. Thank you very much for your kind words.
We are
And
also blessed to have you, sir.
thank
Thank
you
you,
so much.
ICAI, also for that.
Thank you so much indeed. So you don't have the room for any doubts with the class. A wonderful class. Thank you, Nikhil. Thank you so much indeed. It's so beautiful to get those nice, kind words from all of you. Thank you very much. So I'm going to see you on Saturday, friends. Join you back. Thank you very much. Enjoy your day. Thank you.
Thank you, sir.
Thank you. Hanji. Thank you, ji.